Hello, everyone. Welcome to the next edition of the PwC Tax Bite podcast series. And today we will talk about tax control frameworks, a very important and hot topic nowadays. And for that, I invited three colleagues of our tax reporting and strategy team in my virtual recording studio. And that is Maarten, Annelies, and Nikolaas. Very welcome, all three of you. I invited you because you have experience with the implementation and design of tax control frameworks. And of course, this links to the ever-increasing tax governance in general, I would say. So in this podcast, I would like to explore with you a little bit the impact and importance of tax control frameworks. And later on, we also will talk about more practical, how do you approach this as a company. But to start off, I would say, Annelies, can you share a bit what is a tax control framework actually about?
Yes, thank you, Peter, and hello, everyone. I think there are actually many definitions of a tax control framework, but generally it is defined as a set of internal processes, internal control procedures, ensuring that a company's tax risks are known and controlled. It's a framework within an organization that brings together the organization's systems, its processes, its people, in order to ensure accuracy and completeness of data and of all internal and external tax reporting obligations. I really think it's very important to understand that an effective tax control framework is not something that just exists on its own. On the contrary, it should really be part of the overall internal control framework of a company. Um, Also, the objective of a tax control framework is to help companies be in control of their taxes. But even more important for me, per today, it helps evidence that the company is in control. You should not only be in control, no, you should also be able to evidence that towards your stakeholders, be it your internal stakeholders, such as the board or the audit committee, but also towards your internal stakeholders, such as investors, tax authorities, the public in general.
Okay, thanks, Annelies. So now that we defined a little bit what a tax control framework is, let's talk about why it has become so important, because this is clearly not a new concept. It has been around for many years. So why do we notice this increased amount of attention, Annelies?
Yeah, and you were right, Peter. A tax control framework, an internal control framework in general, have become very important for groups, mainly since the introduction of the Sarbanes-Oxley Act in 2002 already. So it's been around for a couple of years, as you say. Since 2002, especially US groups subject to these rules have already applied certain tax accounting and direct tax controls and processes within their internal control framework. Now, since a couple of years, especially a couple of months, we really experience that groups around the world, not only US groups, but around the world, regardless of their location, their business, their size, are putting tax governance as one of the main priorities on their agenda. And they really start focusing on the design and implementation of tax processes and controls. And this can be for all tax types, for corporate income tax, VAT, payroll tax, customs, even local taxes, depending on what is important for that group.
Okay, so indeed, a very, very important topic. It becomes more and more relevant. And when I talk with companies, Annelies, I also hear that the board is raising the question on tax control framework. So the topic is finding its way to the agenda of the boards. Is that also something you notice? And why would that be?
Yeah, indeed. We notice that taxes have become more and more important within organization, as you say, evolving to a boardroom topic. And we see that the tax function has really transformed from what I would call a back office compliance function towards a proactive strategic business partner. We see that tax management, needs to report to the audit committee on a regular basis nowadays, to the board. They need to report on certain tax topics. They need to report on what the tax risks are, how do they manage these risks. But alternatively, I think the board sometimes also envisages certain business restructurings, and they really want the tax team to answer proactively what the tax impact will be of that restructuring. So clients come to us for help in ensuring that they can communicate with their stakeholders in an accurate, in a consistent way, using real-time data in an efficient way. We also see another driver that drives the implementation of tax control frameworks, and this has to do with the various legal transparency requirements popping up in Belgium, in Europe, around the world. Just think about Tax 6, Tax 7, DAC 8 popping up, public country by country reporting, and groups are really struggling to deal with this spider web of increased complex reporting obligations and are looking for robust tax processes and controls to avoid penalties and to avoid public scrutiny for being non-compliant.
Okay, thanks, Annelies. And of course, I see the point on being compliant, being in control, but nowadays a lot is being said also about sustainability. And although, yeah, sustainability has been around for many years, also tax seems to come part of that sustainability footprint discussion. Maarten, let me turn to you with two questions. First, do you see this as well, that tax is becoming relevant for sustainability? And secondly, do you see a link with this discussion we have on tax control frameworks?
Thanks, Peter, and thanks for having us on your podcast. On your two questions, indeed, we see more and more organizations that do need to report on their sustainability programs, or that want to report on their environmental, social, and governance impact, the impact of their businesses. And indeed, what you see is that really tax is climbing on this agenda, because face it, there is a direct correlation between tax and sustainability. Paying the right amount of tax in locations where you clearly create value enables local authorities to obtain funds, and those funds are used to set out sustainable official policies. So ESG reporting now also starts requiring companies to report, or at least think about the societal impact of their tax operating model and strategy. And so companies need to reflect on, what are my tax risks? How do I govern tax within the organization? And what actually is the impact of my tax policies on wider society? And we all know ESG is really a hot topic, and we also see that evolution in the European Union as well, with the proposed directive on sustainable reporting requirements. And that directive just lays out additional requirements to report on certain ESG elements of companies, but at this stage, there is not yet a literal reference to tax in there, but we clearly anticipate that this will come in the near future. And so next to the evolutions within the EU, we also have the global reporting initiatives, also called GRI. And recently in the GRI standards, there has been a tax standard introduced, being GRI 207. And so organizations that consider tax as a material topic to their stakeholders and are reporting under GRI in other domains, they will have to implement transparent reporting on their tax organization. And so the guidelines explicitly state that they will need to report on certain tax topics, such as their tax strategy, their tax governance, and their tax risk management. And reporting on the tax control framework in place within the organization is also a requirement of GRI 207. And so evidently, when making public statements about the tax function, it is really crucial that taxpayers can evidence these statements based on actual data. And a tax control framework, to come back to your question, Peter, really helps taxpayers to be in control, for one thing, and ensure that the statements they make towards the public are actually accurate and consistent. A third point I want to bring to the agenda next to your two questions, Peter, is in the slipstream of all these developments, a lot of companies are preparing or are analyzing their total tax contribution. And I would say in the past, maybe those reports have been primarily used in a more defensive mode, a bit of yes, we may as a company be a bit aggressive in certain tax planning structures, but please see what the total amount of taxes we pay globally. Now, nowadays, a total tax contribution can really help backing up sustainability claims. And those claims are made by specific disclosures that are even made alongside or even in financial reports. We as PwC, we have developed a total tax contribution model that helps organizations building and demonstrating their total tax contribution story. Now, for me, being transparent on tax is the best way to make certain ESG commitments, one, visible, two, make them verifiable, and three, also assess these. So I'm really convinced that we will only see an increase in total tax contribution disclosures in the coming years. But Peter, I do realize I could ramble on for an hour on this topic, but maybe we need to keep that for another podcast. So back to you.
Yeah, thanks, Maarten. And no, it's very interesting what you are explaining and the links that you are making with the broader sustainability debate. So I think for the listeners, it's quite clear what the benefits can be of a tax control framework at this point. But one quick question, Annelies, is it also not sometimes a legal obligation to have a tax control framework?
Yeah, good point, Peter. We do see a couple, not too many, but there are a couple of countries where having a tax control framework is mandatory, or let's say required to some certain extent. However, what we see a lot more is that many tax authorities around the world are initiating cooperative tax compliance programs within their countries. This is really a new approach by the tax authorities in which they would like to stop from having this aggressive conflict-based approach. Let's say they come in retroactively after a couple of years in order to verify in detail each data point in your tax return. Nowadays, within the cooperative tax compliance programs, they would really like to change that and to move towards more collaboration, more trust between the taxpayer and the tax authorities, and where both parties communicate together upfront to the filing of the tax return in a very transparent way about their tax issues and positions taken. Now, in order to step into such cooperative tax compliance program, most countries, also Belgium, require the taxpayer to have a robust internal tax control framework. And so in the intake procedure, the tax authorities will really verify the maturity of the tax control framework before allowing the taxpayer to step into the program. Now, I think, Peter, what's even more interesting, and this is really very new, is that in Belgium, we see that those principles of the corporate tax compliance program and of having a tax control framework in general are gradually finding their way to also our normal corporate income tax and VAT audits, in the sense that during these normal audits, tax inspectors are increasingly focused on tax processes and internal risk management procedures. And this is demonstrated by a recent change to the questionnaire issued by the Belgian tax authorities at the kickoff of a tax audit. I think in the past, the questionnaire was more about what are your disallowed expenses, what is your bad debt, what are your provisions, maybe some questions about material fixed assets. Then a couple of years ago, we noticed that more and more questions are coming on providing data downloads, dumps of data downloads. And now just 2 months ago, we noticed the third section, a new section, which actually says, okay, describe your tax control framework. Do you have a tax control framework? Describe your tax processes. How are you dealing with risk? So it's really a new evolution, and evidently taxpayers, given they only have 30 days time to answer to such questionnaire, should be ready to provide a correct and accurate answer to those questions.
Okay, thanks, Annie. So not only lots of benefits of having a tax control framework, but sometimes also a obligation to have it. That's very interesting. Let's move a little bit more to the practical impact and approach for tax control frameworks. And I think, Nikolaas, that's something I want to ask you to talk a little bit about, because many of the listeners are probably thinking, okay, I see the benefits, but how do I approach it? What are the steps I take to create a tax control framework? Can you shed some light for the listeners on how this is typically approached?
Yeah, sure, Peter, and hello from my side as well. So there is indeed OECD guidance on the six main building blocks of a tax control framework. But in fact, we note that clients are really struggling to bring these building blocks to life within their organization. In first instance, we think it's very important to find out what are the drivers, and discussed at the beginning of the podcast. So what are the drivers for the implementation of a tax control framework within the organization? This will help to shape the design requirements of a tax control framework, and also ultimately making sure that the objectives are achieved. So it is afterwards important to identify what we call the as-is environment and the to-be environment. So what does the company already have in place when it comes to tax processes and controls, and where does the organization want to go to? When you have this as-is state and to-be state, you can in fact identify a roadmap to achieve the to-be state. We in fact split this up, this roadmap, in quick wins versus long-term improvement plans. It is important to understand that a tax control framework implementation is a project of continuous improvement. What I mean with this, it is important to set a realistic to-be state, let's say. You cannot expect to go from a non-existing control environment within the organization to a fully effective tax control framework within, for example, 1 year. So the key to success in the design is to set realistic and manageable to-be state. And once you have achieved this, identify the next steps for a new to-be state. In this way, we gradually and continuously improve the maturity of your tax control framework in a sustainable way, and that makes sure that you have enough or sufficient resources and budget constraints.
Okay, I get it. So you start identifying your as is, your to be, and then of course you have the roadmap to achieve the to be. And I guess it's also more about, yeah, as long as you keep pushing the pedals, you move forward in the right direction. Can you explain a bit more, Nikolaas? How do you identify this as is and to be state?
Yeah, sure. So we have, let's call it, the best practice approach, wherein we typically start from a risk-based approach. So we start a project with the identification of existing risks within the organization that are, let's say, inherent to the business, and map those risks with controls and measurements that are already in place. So together with our client, we start from a risk library in which we discuss the risks and create a so-called risk and control matrix. This risk and control matrix, in fact, qualifies the gross and net risks within the organization and identifies the current control measurements in place. Another important step, of course, is mapping roles and responsibilities. Who does what and when? And it's not. It's important to not forget the people beside tax. Also, other people within the organization whose actions can have a potential impact should be considered. So, having identified the key risks, the next step is to identify tax processes and document these processes via flowcharts or Excel files. Within this phase, we from PwC, we bring especially additional value by redesigning the tax processes to make them more efficient by implementing, for example, some best practices controls, or by testing the effectiveness on the controls and evidencing the outcome. So to drive efficiencies, we are really looking for some quick wins, and key in all of that is to use some small automation techniques, or for example, some advanced technology. So in practice, we see that many of our clients are looking for some automation opportunities and implement those within a tax control framework project, such as, for example, an automated gap to stat tax process, ERP models, or e-invoicing. So that are all small automation opportunities we can tackle.
Okay, thanks, Nikolaas, for sharing that and giving a bit of insights in the practical approach to a tax control framework. I still have many questions, but I'm afraid we are reaching the end of this podcast now. So before I close, I wanted to ask you, Annelies, perhaps if you can give one last message or one last piece of advice for the listeners. I give you 1 minute.
Okay, thank you, Peter. Well, let's then just say we are currently really helping many of our clients increase the maturity of their overall tax control framework. Now, as Nikolaas explained, this cannot be done in 1 day. Some make it an overall tax control framework project. Many others choose to really do this in a phased approach and tackle just 1 or 2 processes at a time. For example, we have a client who is really focusing on increasing the corporate income tax compliance. We have another one who has asked us, okay, how can I increase my tax 6 governance, implement controls in order to ensure that I'm aware when a certain hallmark is triggered. And so I guess the message is within these projects, we always start with a discussion to identify, again, what are the drivers, what are the benefits you want to achieve, what should the outcome be of the implementation of a tax control framework, so we can really ring fence the project and decide on next steps. Now, okay, as you say, I need to wrap up within this 1 minute, and I do realize that it's a complex topic, and there's just so much to say about it. I can imagine that people still have many questions, so I would just say please reach out to us if you have any questions, and we are happy to talk.
Thank you, Annelies. And I think that was very well within the 1 minute. So very well done. With that, I think we come to the end of this podcast. And I would like to thank everyone, the listeners to tune in, but especially Maarten, Annelies, and Nikolaas for sharing their insights with this topic. I would like to remember you that you can subscribe for this podcast via Apple, Spotify, or Google, so you always have the latest edition at your fingertips. And with that, I thank you and I close this podcast.